Right. I'm going to give it a couple seconds. We noticed that it takes a few minutes for the attendees to all populate the webinar session. It looks like we're going to have about 130, 140 people on this one. So we talk about business changes, and I would say that these webinars have been extremely well received, and most likely going to continue to do them as I'm watching the participant count continue to go up. Yeah, I think Zoom's getting overloaded on their servers with how many people are now using them. It's just taking a little longer than normal for these webinar sessions to populate. All right, looks like it's kind of stabilized a little bit. For anybody who doesn't know, my name's James Bogart, Managing Principal of Bogart Wealth. We've got clients and non-clients on this call, so I wanted to do a quick introduction. Administrative items at the top of your screen, there is a Q&A box. If you'd like to click that, I've got that open to be able to answer questions as they come in. And then there's also a chat feature here as well. I've got both of those open to be able to answer questions as they're coming in. Just a quick introduction on Bogart Wealth. Bogart Wealth is a registered investment advisory firm. We're fully independent. Our core competencies are investment management, financial planning, and tax optimization. There are 14 of us on our team. Uh-oh, not working. 14 of us on our team. We have 3 offices, one up in McLean, Virginia, one in Houston, Texas, and then one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. It's really important for us to incorporate that your children and your parents can be some of the largest variables in any financial plan. We've made it part of our firm's culture to give them access to certified financial planners. Many of you have heard me say this, but what would you do differently now that you know what you know, but maybe back in your 20s? And it's not common that your children would have resources to be able to use certified financial planners. So we want to make sure that they know that that's accessible to us, to them as well. All right. Today, we're going to talk about the CARES Act, specifically Coronavirus Aid Relief Economic Securities Act. It was signed into law March 27, 2020. It's approximately a $2 trillion spend. And I'll get into some of the comparisons of how big this bill is, but it's absolutely massive when you start to factor in all of the loan guarantees, which are going to be close to about $6 trillion all in. And you can kind of see the breakdown of where it's at right now. The biggest elements of the bill, obviously, are going to be supporting loans and loan guarantees for large businesses and state and local governments. It's also going to provide loans to small business grants. Today, I'm going to focus mostly on the impact to the consumers, not necessarily getting into a lot of the business-related programs. For our business owner clients, I'm delighted to talk to you more one-on-one because I think that that's more impactful than just talking about it on a broad basis where it's not going to necessarily have as much of an effect for those attending today. But with regards to the size of this thing, I mean, just in comparison, so right here in the middle, the 2020 CARES Act, it's estimated to be about 2.2 trillion, and that's not even counting the loan guarantees. But if we compare it to 2019 federal spending was 4.45 trillion, or 2019 total tax revenue of 3.46 trillion. I mean, it's just absolutely massive in terms of the scope. And just kind of comparing it to a couple of the previous ones that we've seen, the 2009 American Recovery and Reinvestment Act was $833 billion. The 2008 Troubled Asset Relief, the TARP program, was $700 billion in assets. And the 2019 defense spending bill was $676 billion. So massive stimulus program that they're putting together here. And really, what I was saying earlier is we're trying to dive into the personal benefits and what it's going to have in terms of direct impact for clients themselves. So the first question a lot of people are asking is, am I eligible to get a check? how much is that check going to be for, and when can they expect to receive it? So with regards to the direct stimulus checks, they're estimating it's going to reach over 93% of taxpayers. Now, this is being structured as a refundable tax credit for 2020 for those that qualify to get the check. Now, the check is going to be for $1,200 for individuals, $2,400 for married couples, and then additional $500 for each qualifying child. And we see a lot of questions for, what is the definition of a qualifying child? So that really it's any child that's under the age of 17. Now, a lot of people say, well, I've got a 22-year-old that's in college, they're a dependent of mine. Unfortunately, they're not going to count. Any child that's 18 or over is not going to be eligible to receive the additional $500. So if they're considered as a dependent of the parents, they might not necessarily qualify for a rebate all on their own. So those of you who have children who have graduated, who are working on their own and file their own tax returns, then those would be eligible to receive the $1,200. But those that are still in school and not filing returns, not going to be eligible. The other big hot button item that we're seeing is that the parents are, a lot of people think, well, are they going to send the check to the children? No, that's not the case. The check is actually going to get sent to the parents, and it's going to be made out to the parents. So it's not like these minor children are all of a sudden going to be getting money sent to them. Now, in terms of these rebate checks, there are phase out limitations on them. And basically for anyone who's married filing jointly, it's based off of adjusted gross income. And I'll talk about how they're determining that in a minute. But they start getting phased out at $150,000 for those married filing jointly, $112,500 for heads of households, $75,000 for anyone who's single. Now, the phase out works is it phases out at $5 per $100 of additional income. And truth be told, not every household is going to get the same tax credit. This is a neat little chart that came from Michael Kitsis's group, specifically talking about the refundability of these tax credits and what they look like. So for example, all of them will have a different starting point on the vertical axis here. So single person, we already know it's $1,200, and it starts to get phased out at $75,000. And so if they make up to 100 grand, they're not going to get a check if they're single. And then you can see, for example, on the other end of the spectrum, someone who's married filing jointly with two children, they're going to end up getting a check for $3,400. And obviously, as we said, there's phase out for married is at $150,000, and it starts to phase out all the way down. So the most critical part of this is that if you have a phase out and you ultimately have children who are also on your phase out, it can absolutely take longer, more income before it ultimately completely gets phased out. Let's see, I got a couple questions that came in. I wanted to address those. I have two sons, 22 and 25 in college, both filed their own taxes in 2018. I claimed both as dependents in 2018. Will they get the $1,200? So the answer is if they were declared as a dependent on yours, the answer is no, even though they filed their own tax returns. So something to be aware of. I saw one about Virginia filing date. I'll come back to that one in a second. All right. So as I mentioned earlier, these are going to be structured as refundable tax credits. So they're going to pay you the money, and then you get to treat it as, basically you've already overpaid your tax returns on your 2020s. So for anyone who has a tax obligation, it'll either be satisfied against that, or if you don't have a tax obligation, you're obviously not going to owe on this. Now, they're basing it off of 2019 tax returns if filed. Otherwise, they're basing it off of 2018 tax returns. So that then also creates a little bit of delta, because if you had a great 2018 income, but a lower income in 2019 that would all of a sudden make you eligible, then we absolutely want to see you accelerate filing your 2019 if the 2019 income is lower and more favorable in this instance. Now, for tax payment obligations, they are not going to be owed until July 15th of 2020, excuse me, for federal. Now, someone asked, is Virginia tax filing date still May 1st? The answer is yes. Virginia has not modified their tax filing date yet. I anticipate they probably will, given that they are, I anticipate that they will, given that they are very stretched thin in terms of their resources. Had another question come in. Didn't see anything for head of household with no children. Go back to this slide here. So head of household with no children, they're this green line right here. Nope, excuse me. Yeah, head of household with no children, then you still would be getting the $1,200 check, but your phase out would be a little bit higher. So it's going to be this green line here, but it's going to go at the 112 mark and then start phasing down. All right, coming back here. Now, in terms of if you had a high income in 2018 and 2019, but you're now unemployed, what is the impact or ability to get one of these tax credit checks? Unfortunately, that category of individual is not going to get the actual check now. So think of it this way, like in this Northern Virginia area, we've got a lot of contractors, for example, where they might have had big income in 2018 and 2019, and now they're either unemployed or furloughed and their income's dramatically dropped off. Unfortunately, they're not going to get the check. However, they're still going to be able to get the tax credit on their 2020 returns. So here's kind of a neat little illustrative piece that talks about the different households and what their eligibility are. Vertical axis is the 2018, 2019 income. Horizontal axis is what their income is in 2020. So easy one to talk about here is if your income's lower than the threshold in 2018 or 2019, and then your income's also lower than the threshold in 2020, you get the recovery rebate now. You get to keep the recovery rebate. Now, for those that are in the category of their income was higher than the threshold and it stayed higher than the threshold, is this red group over here. So if you're over any of those respective tax brackets in 2020, 2018, 2019, and 2020, there's no recovery rebate now, and you're not going to be able to apply for one on your 2020 returns. Now, the group that I just mentioned a moment ago, where let's say they had high income in 2018 and 2019, but all of a sudden their 2020 income is very low, is this yellow category here. There's no recovery rebate now, but they can get the recovery rebate applied to their 2020 return. So they get some level of cutoff here. And then there's this last group, the group that their income in 2018 and 2019 was low and they qualified, but then all of a sudden their 2020 income is higher. Well, they're going to get the recovery rebate now, plus they're actually going to get to keep that recovery rebate because there's no clawback on that. So the toilet paper distributors who didn't really have big incomes in 18 and 19, and all of a sudden, for whatever reason, with the run on toilet paper, they might see a massive spike in income, they'll still get to keep that check. All right, quick question on what is the cutoff date for 2019 versus 2018? If I have not filed the 2019 at this time, is the 2018 return used? Yes. So the answer is if you have not filed your 19s yet, they're going to base it off of your 2018 returns. If your 2018 returns are lower than your 2019, then I would wait because federal filing is not going to be until July the 15th now. If your 19 returns are going to be lower than your 2018 returns and it's going to allow you to qualify for this, then I would hurry up and get those done. Another question is if the slides are going to be available later. Yes, we're going to make the slides available, and we're also recording the call that we can send it out if you'd like to listen to it later as well. All right. In terms of when will these things be paid? Now, they keep saying as soon as possible. Michigan said that they're trying to get them out 3 weeks in 3 weeks. I heard them also say that they're going to try to get them out April 13th. But based off of history and previous stimulus initiatives, for example, the TARP program, it's probably going to be May at this point. Now, in terms of how they intend to pay these checks out, For anybody who's taking Social Security, the recipients will receive where they get their Social Security check. And then for anybody who had a refund on their 2018 or 2019 tax, then they're going to actually direct deposit it back into that account. Now, obviously, this does create a couple questions. Many of us might even ask, what is a refund? But what if that account doesn't exist anymore? That's going to create some administrative hassles and hurdles as well, and that could cause some further delay. And then for anybody else who doesn't have Social Security checks or doesn't have 2018 or 2019 tax refunds, they're otherwise going to send the check to the last known address on file. So that could also create some administrative hurdles, because if you've moved and haven't filed your taxes yet, updating your address, then you're absolutely, as soon as possible, going to want to fill out Form 8822 to update your address of record with the IRS. And again, that's Form 8822 if you've moved. All right, that's kind of the logisticals on the checks. Now we're going to talk about a couple tax and retirement questions here. Yeah, someone made a comment about fraud, nightmare, and scammers cashing people's checks. I imagine there's going to be, we saw some of that with TARP too. There is going to be some of that. All right, talking about tax and retirement provisions. So this is coronavirus related distributions from retirement accounts. So you can actually take up to $100,000 from a combination of IRAs or employer plans and not have to pay early withdrawal penalties from them. Now, these distributions must be made in 2020. Now, we say 2020 because it's really important to talk about this. They opened up the time horizon. You can actually start taking this starting January 1st, 2020, all the way through to December 31st, 2020. Obviously, coronavirus didn't start having an impact in the US until latter part of February, early part of March. So this is going to also cover folks who started taking some distributions from their retirement accounts ahead of January 1st, excuse me, ahead of when coronavirus here all the way through this calendar year. Somebody asked a question about, can new Cares feature help bridge retirees under 59 and a half? The answer is yes. I'm coming to that right now. But most specifically, we can take 100,000 out of IRAs and employer plans without paying that 10% penalty. Now, in order to be able to qualify for this, there are some rules associated with it. First, you have to have been diagnosed with COVID-19, have a spouse or dependent diagnosed with COVID-19, or experienced adverse financial consequence as a result of being quarantined, furloughed, being laid off, or having reduced work hours because of the disease, or you're unable to work because of lack of childcare as a result of the disease, or you own a business that is closed and operated under reduced hours because of the disease, and lastly, or because you meet some other reason that the IRS deems as okay. You know, truthfully, I'd rely more on these top five, not necessarily the last one, because I'm sure the IRS is going to be inundated. But it's pretty safe to say it's a broad and very encompassing list in terms of qualifications for those that are under 59 and a half and need to pull funds out of retirement plans to be able to live. This is something that we can use as an option here. All right, so as I mentioned, if you're under 59 and a half, they're waiving the 10% withdrawal penalty. They're also not subject to mandatory withholding requirements from an employer plan. Historically, the employer plans required a 20% withholding off of these. Now, most of these 401k plans do not have this updated on their systems yet, and inclusive of ExxonMobil's, or if you have a 401k somewhere else, you're going to need to tell them that, and they're calling it self-certify, that you've been impacted by COVID-19, and you need to tell the administrator that this is a coronavirus related distribution, and they will do the distribution without any withholding. Just something important to note if this is something that's going to apply to you. Now, if you do take money out of a 401k or an IRA account, you actually can repay it over a 3-year period of time, and they use the term roll back. Now, we do suggest that if you take a distribution, you go ahead and claim it on your tax returns. So you report the distribution as income until you roll those amounts back in, and then you go back and amend prior year's returns to get a refund. It might be best to wait until you have a more significant amount to roll back in. So let's just say you take 100 grand out, wait until you have 30 or 40,000 to put it back in to be able to get the tax reduction associated with it. As I mentioned, it's still taxable, but you can actually spread that tax bill out over that 3-year period of time. So unless 2020 is a hyper low income year, then you potentially want to spread it out. So, you know, some of you who may or may not have been laid off or income has dramatically reduced because of what's happened with COVID-19, maybe 2020 is the year that you just declare these IRA distributions all as income. And then if you pay it back, then you can ultimately get a refund off of it. And it's also not an option to do a partial amount. It's either all or none. So we ultimately need to declare the income, but we need to do it all or none. All right. Couple other things here. They did modify loans for employer plans. So the maximum loan account that was available on a 401k plan was $50,000. They increased it up to $100,000. Now you can take up to 100% of the vested balance that may be used. Previously it was 50%. And payments on the plan loan otherwise owed can be delayed up to a year. So if you have a 401k and we need to take a loan out, you can do up to 100 grand as a loan, and you can delay making any of those payments for up to a year. Now, in order to do this, you obviously have to still be actively employed, but it might also be a nice bridging mechanism if that's something we need to be considering, and especially if we can delay the payments for a year to be able to do it. Those that are retired but still have their savings plan at Voya, unfortunately, you're not eligible for loans, so that's one where we need to look at other distribution options there as well. I got a question came in. Do these require the valid COVID-19 related reasons, or no reason needs to be mentioned? For 401k loans, no. For 401k loan increases, no, they don't. They're increasing the plan provisions across the board. For IRA distributions, yes, you have to self-certify and tell them that it's a coronavirus related distribution. All right. One of the big ones for a lot of our retired clients is that required minimum distributions are waived in 2020. So all RMDs are suspended for 2020. So you are not required to take out any money from IRA accounts. That also includes employer retirement plans, 403B plans, and 457B plans. For first-time RMDers, those that turned 70 and a half last year, early this year, you actually had the ability to do a distribution for last year all the way up until April 1st. And those that then you'd have to do the second one for 2020. You actually are going to get the ultimate reward here, where you get forgiven 2 RMDs in that regards. Now, in terms of the ability to declare a couple adjustments to this, it also suspended RMDs that may have otherwise needed to be taken. So inherited IRAs, anyone who has a stretch IRA, those RMDs are suspended. And then anyone who was taking inherited IRA distributions out over the 5-year rule, this is also being suspended as well. So if you were you inherited an IRA account and you missed the ability to stretch out your RMDs, but have ultimately are now taking them out over a 5-year period of time, you can ignore this for this year. Now, the Secure Act changed the way that inherited accounts worked for 2020. It ultimately did not extend the new Secure Act's 10-year rule to become an 11-year rule, because anyone who dies in 2020, you're not obligated to take an RMD in 2020. You have till the year after the year of death. So ultimately, there's no change to any of the rules associated with Secure Act. All right. Now, rollbacks of RMDs waived in 2020. So let's just say, you know, the early bird gets the worm. You've already taken RMDs out, or right at the beginning of the year, you decided to pull out the entire amount of the RMD. do we have the ability to pay those back? Now, if you've already taken them, there's the 60-day rollover rule, if applicable, that if you have not done a rollover to an IRA account in the last 365 days, you can put any money that you've taken out of the IRA account for the last 60 days. So those that have already started taking RMDs out, we have the ability to get them back in as long as it's within that 60-day window. Now, we also have the ability to say it's a rollover as a coronavirus-related distribution. So if you're impacted by coronavirus financially, then you could use the COVID-19 distribution provision of that January 1, 2020 to December 31, 2020, and then have a 3-year period to repay funds. So you could ultimately use that as well as something to talk about. I had a question. What if only one spouse is impacted by COVID? If any person in the household, whether it's husband, wife, or any of the dependents, has COVID-19, all of these rules apply. I also had a question on define self-certify. Self-certify means that you need to tell the plan that you've been impacted by COVID-19. Goes back to that list that I provided. But essentially, if you or anyone in your household has had COVID-19, if you've been financially impacted by COVID-19, those are all reasons that would be a reason to declare a COVID-19 impact. All right, back over here talking about RMDs. Unfortunately, if anybody took an inherited IRA RMD, there's no ability to pay those back. So those of you who might have taken them out early on, that's one that we're just going to have to bite the bullet on, unfortunately. All right, click back over here. Now, they also created a new above-the-line charitable deduction. Now, this is very different than qualified charitable deductions. It's a qualified charitable contributions. So it's very different. Don't want to confuse them. But anyone who itemizes their tax returns, this does not apply to you. This is for anyone who takes a standard deduction. Now, candidly, when we talk about broad market America, it does have an implication for a lot of people, but it is not the same as anyone who itemizes will still use charitable deductions through itemizations. Specifically, don't confuse the qualified distribution over the age of 70.5. So one of the provisions that passed as part of the 2018 tax reform bill was that you could take money from retirement accounts to satisfy RMDs and not have that counted as ordinary income. This is very different than that. This is a brand new above the line deduction that they're putting in. It's limited to $300 per individual. So husband and wife, you can do $600. It must be made in cash. Cannot use highly appreciated positions. It also must go directly to a 501c3 charity. Cannot go to a donor advised fund. It cannot go to a 509A3 supporting organization. And as I've already mentioned, it only applies to those who do not itemize and are claiming standard deductions. Now, truthfully, a taxpayer that's in the 37% bracket that's taking standard deductions, it's estimated this is going to save them $111 in taxes. Those that are in the 12% bracket, it's going to save them about $36. So, I mean, it's nice to do, and obviously support causes here that are hurting desperately, but something to also be mindful of. All right. Couple other changes that we've had coming in. They also expanded itemized charitable deductions. So AGI limit for charitable contributions has been completely temporarily repealed for anyone who does cash donations to charities. So they effectively increased the AGI limit from 60% of your AGI up to 100% of your AGI. And again, same rules apply here. The money must go directly to a 501c3. It cannot go to a donor advised fund, and it cannot go to a 509A3 organization. But from a planning perspective, for those that are charitably inclined, you can effectively completely wipe out your 2020 tax bill by donating the equivalent of your AGI. And again, it has to be cash, has to go straight to a 501c3 organization. But something that is potentially an attractive option along the way. Sorry, I had a bunch of questions coming in. does charitable deductions start with 2019 or 2020 taxes? Sorry, these are the charitable deductions are just for 2020 taxes. It's not counting anything for 2019. All right. Click on the screen. Another notable provision along the way is they did do relief to student borrowers. So anyone who has federal student loans, they are deferring. You are not required to make any payments until September 30, 2020. There's no interest that will accrue for during the interim for federal student loans. It will still count towards loan forgiveness programs. So if you qualify for debt relief programs, stop making the payments right now. You know, if you're in a position where you work for a charity or a nonprofit organization that pays your student loans for you, there's absolutely no reason to continue to be paying these things down if they're going to be ultimately forgiven by whatever organization you're working with. Now, required payments are suspended, but voluntary payments are not prohibited. In order to take advantage of this, you have to proactively go in and stop the payments if this is something you desire to do. They're not going to automatically suspend. So if this is something you want to do, absolutely go in and make sure that you stop making those payments. Also, they did suspend involuntary debt collections on federal student loans, also suspended. All right, I've had a couple questions come in. If I normally donate appreciated stock, do I need to sell the stock myself and send the cash? The answer is you can still donate highly appreciated stock up to the 30% AGI level. That didn't go away. What this provision specifically did here was if you are a cash donor or somebody who normally gives cash to charities, you can give more. I don't necessarily think it makes sense to sell stock for you to pay the capital gains rates in order to give cash, but ultimately we can help you with doing the math of what makes the most sense. And we can look at all different strategies. It's really a function of how much we're talking about giving in this regards. Let's see. Oh, I have another question that came in. What proof or evidence is required of self-certify and use one of those reasons? You know, ultimately, they've been very vague about what they're going to use in terms of proof. I do think that the argument about financial implications for coronavirus implications is one that would categorically cover pretty much every household at this point, because no doubt market volatility has had a direct impact. But if you've in any way, shape, or form your employment position has been impacted, that's something that will absolutely qualify you for a COVID-19 implication, and I think would be easy enough to make that argument for a lot of households. Let's see, I had a couple more questions, sorry. If any involuntary student loan payment is already been applied for the federal tax refund due, can it be appealed and recovered? The answer is no. If it's already been made, we're not going to be able to get the payment back from them. So it's one of these that we want to be proactive on and cancel anyone's going forward, unfortunately. All right. That is all I was going to cover today. You know, we're available for anybody who needs to sit down, rerun the numbers, or have a plan get done. You know, part of our call to action is to help educate investors, and one of our core competencies is looking at financial planning needs as well as tax optimization strategies. So if this is something you'd like to talk about with us, please feel free to reach out. We're always a resource for you. I know we have a lot of clients on this one today, but it is part of our service model and what we do. And if any one of these strategies are directly impacting, we're obviously reaching out to clients proactively to start making the adjustments necessary. But it is something that we should be incorporating in terms of our holistic planning needs. We're having a great level of success with these webinars, and we're sending out the invitations for these. I've got a couple more coming up. I'm doing one on April 8th on why we should consider doing Roth conversions now. Then I'm doing one on April 15th in the morning. It's a different time than normal, on how to generate income in a recessionary environment. And if you need anything, here's our contact information here, but we're more than delighted to be a resource along the way. I still actually have a couple more questions coming in. Let me see if I can get these before I end. Is it possible to text copy of the questions that were asked during the session? That's a great question. I'm not sure on that. I believe I can get a text copy of all of the questions. I'll let Mike work on that one for me. Let's see. All right, I'm going to go ahead and wrap up. If I missed anything today, please feel free. My email's there, Michael, Pete, Grant. Send any one of us a question. We're delighted to be a resource and help with any of the questions you guys have on this. Obviously, more and more data is coming out on these things every single day, and we will continue to update our presentations and any resources that we think are pertinent for clients or prospects and get them out as well. But stay safe, stay healthy, and we're here for you. Thank you.